My name is Vern Hoven. I am a CPA with a master's in tax law.
And I'm Sharon Kreider, and we are here in Western CPE's studio, and we are in beautiful downtown Bozeman, Montana, for this webcast. We have a guest joining us, Vern. Karen Brosi is coming in by Zoom. I think that's turned into a verb now. Karen Brosi is zooming in, is zoomed in, something like that, to be our expert on real estate, or at least to share with us some information. Now, this all starts, Karen, with a New York Times article. A New York Times wrote a story on President Trump's taxes. Now, none of us have seen the tax return. We are only reading what the New York Times wrote and their analysis of tax returns for 18 years. And they reported, New York Times reported, that the president paid no taxes 11 of 18 years. And then in 2016, which was President Trump's election year, the year he was elected, he paid $750 in tax. And in 2017, President Trump's first year of presidency, he paid, coincidentally, $750 in tax.
We're not going to talk about the article, but rather we're going to answer your question, your client's question. How can I pay zero tax?
And that's exactly what we're beginning with, isn't it? Didn't you? I mean, I was telling Karen and Vern that I follow tax Twitter, and on it, one person asked, how many of you got questions about how do I pay $750 in tax? And he'd had 6 that day. Not obviously clientele with lots of income and lots of tax. Because we promised not to talk about the article or the president's tax return. Instead, we promised to ask Karen questions about who can have lots of income and pay zero tax. That's our real question.
Because that's what we know. What we know is that my average client, who is high income, but maybe that is mostly earned income. He's not even an entrepreneur. He is a CEO of a publicly traded company. And so most of his income is wages. And then there's investment income. So my client, however, that client who says to me, I want to pay zero, how come I'm paying so much in tax? I have to say to them, in part, it's because you have the wrong kind of income, but you're not going to give up that income. So it is the cost in this country of having the wrong kind of income that results in a much higher tax. Having the right kind of income and being willing to dispose of some of that income in certain very specific kinds of ways is what can ultimately result in a much lower overall tax rate. Now, that's theory. Okay, so let's take a couple of examples. What I like to liken it to when I talk to my clients is this. First of all, it's what I like to call the Warren Buffett phenomenon. Several years ago, there was an article quoting Warren Buffett. And that was when there were lots of discussion about flat taxes. Should we impose a flat tax in this country? And Warren came out in favor. And he said, absolutely, because something has to happen with our tax system, because our tax system is fundamentally flawed when I pay less tax than my secretary. That was Warren's quote. Well, those of us who are actually on the inside of tax preparation knew the right response to that right away, which was, of course you do, Warren. Of course you pay less tax than your secretary because she works for a living, because her income is the wrong kind of income. It's wages. Your income is investment income that either is already subject to a much lower tax rate, is even further favored because you are um, a organizer of hedge funds, and therefore you get carried interest, the tax treatment of carried interest. And in addition to that, you're spending money to make money, and so that will generate for you, favored under the tax law, certain development credits, certain jobs credits, and certain other kinds of investment credits. And so to answer the question, Vern, how do I take advantage? How do I get to where I can have a lower income? First of all, that's, I think, my short answer is have the right kind of income and be willing to spend some of that right kind of income to generate additional tax benefit.
And President Trump was, and his company still is, a developer, a real estate developer.
Mm-hmm.
And we know that, for instance, your CEO that makes several $1,000,000 a year, even if we said to him, well, let's go out and you should buy a big property, you should buy Trump Tower, and you should rent it out, that would still be passive losses for him, not income. So
Correct.
I want to say that we want to talk about developers. Let's talk about developers. So, and we start with, did did President Trump's tax reform bill, certainly a signature of his first term, did it benefit real estate investors and real estate developers? Tell us how that works.
It can under the right situation because it's all about that dreaded QBI, right? It's all about qualified business income. That as Congress had gotten a long way down the pathway there, they had determined that they wanted this credit for businesses that were not C corporations, that they wanted this credit based upon the income of any other kind of business entity, qualified business income entity. And they had gotten a long way down that path to include that they had figured out that they didn't want certain high income individuals to get too much advantage of this, that they had to be putting money back into the economy, i.e., by having employees that they were paying, so that they had, if my income was too high, and I did generate qualified business income, then I had to be pouring some of that money back into the economy by having employees with to whom I was paying wages, because my qualified business income deduction would be further limited by a percentage of the wages that I was paying. So Congress had gotten all the way down that, certain caps for high income folks, and but qualified business income. And then they started to think about a real estate developer or a real estate investor who owns, shall we say, for example, a great big office building in downtown Manhattan. Now, the owner of that great big office building in downtown Manhattan, there's no question that that income is qualified business income at a very high level. But does a real estate owner have, or investor of that sort, have employees? No, they have a property manager, and the property manager has employees. But the business owner who is receiving that high income, does not, so they would not qualify. So what, of course, tax cut, that's where we got what we already know, because we've been dealing with it for a number of years, which is there is a limitation, but it does allow for some QBI deduction as long as I have unadjusted basis in my property that I use in the trade or business. So that was the really big benefit, I think, that came out of Tax Cuts and Jobs Act, was that provision. So it certainly applies to smaller income folks who have real estate investments, because there's no limitation except the normal QBI deduction limitation. But there was a real big benefit for higher income real estate owners and investors and developers.
I suspect that a developer who keeps it now, we keep calling this a developer, this person, this taxpayer, developer, but really a developer builds and sells. And that's
Correct.
just inventory and that's just ordinary income. No
Right.
exchanges, no nothing. Instead, I think we want to talk about a developer who builds the building, builds the hotel, rehabs a building, and then keeps it for a period of time. Because what we're looking at is depreciation. I think we want to talk about how much depreciation deduction can you have, and why would you have a depreciation deduction for developing a piece of property?
Well, and of course, the depreciation deduction at its heart is, as we all know, it's about recovering your expense to acquire and improve the property. Now, one of the things the Tax Cuts and Jobs Act did to us, there were two things. One is that it, of course, allows us to continue with depreciation and to take depreciation and use the unadjusted basis for qualified business income deduction, as I said. But the other thing, and this kind of came in two steps, was Congress wanted to finalize in TCJA this notion of, if I do qualified improvements to certain kinds of property, to qualified retail or restaurant property, or qualified tenant improvements to other kinds of property, that Congress wanted to allow me not to use what has always been a standard 30, for a long time, been a standard 39 years to write off that expense, but instead give me a much shorter period of time to do that, only 15 years. So in Tax Cuts and Jobs Act, Congress was trying to finalize that, to make sure that that kind of improvement would give me a much shorter lifespan, depreciable life, but also, because of the shorter depreciable life, take advantage of something else in TCJA, which was bonus depreciation, first year bonus depreciation. So that's where they were aiming. We know that there was a hiccup in there about attaching the 15-year life and getting it for sure to be eligible for bonus depreciation. That was fixed in was it the CARES Act this year that put the qualified improvement property fix in that should have been done back in TCJA. So all of that really gives a business owner, though, or a real estate owner, a real advantage to recovering costs. So that I buy this property, I rehab it, or I further develop it out, I start to generate revenue on it, and I can write off my costs against that revenue in a much more rapid manner.
And I suppose writing off your costs is really that old accounting 1A of matching revenue and expense.
Yes.
Right? It's easier to see when we talk about a machine that I spend $1 million for and it's going to last 10 years. It'll be obsolete or worn out. I need to be able to write it off over some period of time. A building has been harder for us to conceptualize because the building has been increasing in value because of inflation and location and a variety of reasons, so we don't see it wasting away. But depreciation is a paper write-off. It isn't necessarily my money I spent. I borrowed the money. I borrowed the money even for the rehab. I might have borrowed. In fact, I know the rehab on that post office building on Pennsylvania Avenue in D.C. is estimated at $132 million. That probably wasn't cash in, and it generates a rehab credit. These are all, Karen, are these loopholes for developers?
Well, of course, one can call anything that is a tax
me.
advantage.
Yeah.
We can call it a loophole. Okay. But what it really is it's a tax advantage. So when I see a tax advantage in the law like that, I say, why? Now, you and I have long had this discussion that you can ask me any kind of tax question, but I'm not sure you can ask me a why question.
I know.
But when I look at that, I say, okay, was there policy behind this? Certainly, because when you see an advantage like that, it is about encouraging encouraging a business to rehab, to develop, to not just tear down or leave a slum building, as it were, but to encourage them to redevelop it. That makes not only the neighborhood, the property itself, and the property around it more valuable, which is to everyone's benefit, but also increases jobs, doesn't it, in the process of doing that kind of work. So, yeah, I can see that the tax advantage is placed in the law for that very purpose, is to encourage that kind of business investment.
And pay for risk. It's a
Yes.
development is a high risk. I mean, we do know that many people lose money on their developments because they
Yes.
picked the wrong time. We saw the recession, the housing recession certainly could have been part of that. So I think we agree that there isn't a loophole involved here. But we go back to your CEO and we say, how does that CEO who has wages pay zero? Can he be a real estate professional? Could he be an investor in a development and have deductions? I think what I'm asking you is tell me a little bit for our clients on how you might respond to the passive issues and the real estate professional issues.
Right. Well, and certainly the situation there is that I do tell my clients that the passive losses. So you become the real estate professional. No, you become the real estate investor, because what we all know is very specifically under Code Section 469, a CEO of a publicly traded company in this country is not going to qualify as a real estate professional under the rules. So they're not going to be that. So that does mean that their investment, if they are just an investor in real estate and it is generating losses, that's not going to offset their other wage income. That is not going to help them in the current year. But I never discourage that kind of investment, because what I do like to remind clients of is while passive losses may not be deductible by you in the current year, they represent money in your pocket in the future. Because passive losses don't just disappear if you dispose of the activity in a complete disposition that's a fully taxable transaction. So those losses are recoverable in the future. Whereas, so take the opposite of a developer who perhaps is able to take losses on their property currently. Well, all they've got now is a great big pot of gain growing, appreciating and growing and growing and growing. And if they want to dispose of that completely in the end, that's just all going to be taxable to them. What our client is doing, that CEO, by investing, not able to take the losses now, that's okay, because they're going to push that loss into when they actually recognize the income and help overall lower the tax result when they come out the backside. Now, nice to say, not every client believes that when I tell them that. But, or not, because they're looking for current gratification, aren't they? And I think that the only way to give a client like that current gratification is for them to be the developer. I mean, the true developer, like I know, Sharon, you have a client who is the developer.
And pays no taxes.
Correct. Who puts together the deal with other investors. And then the result is that their investment becomes a part of what is eligible for carried interest treatment and can get them a much better result tax-wise in the end.
And while I quickly said the developer doesn't pay any taxes, he pays taxes and then he doesn't pay taxes, because what we are doing in our tax system, I think, is rewarding the risk, because there's a negative cash flow on new properties in development. There is
Yes.
money going out for, while they're in development, all these capital costs, interest on their loans, money going out, all of it capitalized perhaps while they're in development. Then the depreciation starts up, and so it's an up and down. It is definitely up and down for that, for my particular developer client. I think we just have one more topic to ask you about, and that is,
This is a bonus real estate one. We're just going to get you while we can.
Oh, this is the bonus round?
yeah,
is
just
the
the
bonus
bonus round,
round.
but just one question, because we know that depreciation is a deduction today, but you
Yes.
do have to pay taxes when you dispose of the property, except if you have a 1031 exchange.
Oh, I had no idea where you wanted to go on this. Hey, Karen, how does a like-kind deferred exchange, 1031 exchange, help the real estate investor who's not a developer that's selling inventory?
Correct, because 1031 exchange is not available for inventory. So the developer doesn't get help there, but the real estate investor does. Now, I always like to start this discussion with that most tax practitioners, most tax preparers say that 1031 exchange is, of course, one of the wonders of tax savings under the tax law. And I cannot help myself when I talk about 1031. I cannot help but quote a very good friend of all of ours, who has been a great tax instructor for many, many years, and that is Danny Santucci. Because Danny Santucci used to describe an investor's life, a real estate investor's life is as follows, he said. From the time you acquire rental real estate, the rest of your life looks like this: exchange, 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 die. And he was right.
Not a good
Because
plan for me personally on the end.
Done correctly, if done correctly, I can acquire an asset that, yes, is paying me a cash flow, is appreciating in value, and that if I don't like it or it gets worn out and I want a different one, I can get rid of it and get a different one without having to pay the tax currently. So if doing that continuously and then dying, no one, as long as there's a step up in basis on death, no one ever pays the tax. So the bottom line, so that's my, how does it work? The bottom line is this. Code Section 1031 says that no gain or loss is recognized if I exchange trade or business use or investment property for trade or business use or investment property of a like kind. Now, since Tax Cuts and Jobs Act of December 2017, the only thing that is of a like kind, that is trade or business use or investment property, is real estate. So it used to be that I could also include in there of a like kind other tangible personal property used in a trade or business. I can no longer do that. But when it comes to real estate, and all I have to do is dispose of real estate that is either held for investment or used in a trade or business, and exchange it for real estate that is, and how do I know it's like kind? Well, that's the other beauty of 1031, is when it comes to real estate, the definition of like kind is very broad. Basically, any kind of real estate is like kind to any other kind of real estate. I can trade a house for an apartment building for an office building, any of those for bare land, or bare land for any of those. The only thing when it comes to real estate that is not like kind is foreign real estate. For non-US real estate is not like kind. And so that definition is very broad, so you can see where an investor can really leverage themselves. I buy or I acquire this little single family dwelling, and I hold it for a long time, and it greatly appreciates in value. Now I start to like it a little less because it's a single family dwelling with a lot of value. So I want, and that value is all contingent on a cash flow that's coming from one source, one tenant. So wouldn't I like to trade that? Wouldn't I like to maybe have all that value invested in something that has multiple sources of income, like a small office building or an apartment building? So the beauty here is I don't have to recognize the gain on the sale of the house. I can move that gain over without paying tax on it into the next property that will also further appreciate in value, diversify my revenue source, etc. And as you can see, I could do that for the rest of my life.
Thank you.
So
Thank you for that.
if I wanted to say how I could pay zero taxes, I would need a lot of money to invest. I would need a lot of leverage. I would have to be willing to take risk, right? Risk on the development of some property.
Mhm.
And I need to maybe maintain the ability of the tax deferred exchange, right? We do know, Karen, because we've discussed this earlier, that Vice President Biden would like to limit tax deferred exchanges. That was also a proposal from President Obama. It is not from President Trump presently.
Right.
So maybe we have a discussion again on tax deferred exchanges at another time and how real estate.
It's not going to happen. Sorry about that, but keep going. I can't imagine them doing away with like-kind exchange on real estate.
Well, it had a limit. I think it's $1 million. Wasn't it $1 million?
Right. It was $1 million of gain deferral,
Yeah.
I believe, in the Biden plan. But Vern, that's an interesting comment, by the way, because the truth was no one was more stunned, I think, than I when TCJA made the change it made to 1031 exchange, because I believed 1031 exchange was like a sacred cow out there, giving people the ability, business owners or investors, the ability to do that kind of trade up, if you will, or trade in, if you will. And so when tangible personal property was eliminated from that, I was stunned. I was really quite surprised by a change to 1031. So that taught me never to say never about any kind of particular change that could occur in the tax law.
Well, thank you to Karen
don't
Brosi.
know what to say to that. You are right, and I'm wrong on that part.
Well, you can't trust anybody who's a politician. Ooh.
I know.
You can trust, the most trusted occupation?
Let's close.
Us.
Us.
Yep.
So thank you, Karen Brosi, our guest and
Thank
our
you, Karen.
expert on
Thank
real
you.
estate today. We hope we've given you a few answers, and I'm sure there are more questions than there are answers in our career. So thanks, Karen. Talk to you soon.
Thank you.